I am going to talk about the importance of staying invested. It has been a rough year so far. And so, first of all, I would like to get started with a question, a generic kind of question that I would like you to consider. So, let's say your favorite pair of jeans go on sale. Would you consider buying it right away, or would you want to stay for it to maybe go on additional sale? Or would you even just give up the idea of buying a sale, thinking that it's gone on sale, so maybe it's not the best quality? Would your answer change if the jeans rarely only went on sale like this? Or if the news, when you go back home, you listen to changes about the oil prices or supply chain issues, or the headlines are all about doomsday or failing economy or a World War III, for instance. If it doesn't change for a pair of jeans, should it change for your portfolio? As I mentioned before, over the past year, we have seen that financial markets go through a relatively calm period and then bouts of unexpected spikes in volatility. For most investors, volatility isn't fun, of course, and that's also reflected in the investor sentiment we are seeing nowadays, which has slumped to pessimistic levels. It is no wonder that most of the thoughts or questions we hear are about time to get out of the market or at least hold on to excess cash until the storm passes. The short answer to that is that it's not. It is important to recognize and understand that volatility is normal and, of course, beyond our control. There's only so much you can do managing and holding on to your portfolio. Actually, in fact, for most investors, long-term investors, is probably actually the time to stay or get invested. While it is true that past performance is not indicative of future presence, I have listed 5 reasons based on historical evidence as to why it is beneficial to stay invested over the long run, despite a rough market. The first one being that there's always something to worry about. Best days come quickly after down days, and in conjunction with that is just that timing the market is often very difficult. When others are fearful, be greedy, they're more often than not a lot more opportunities to get invested, and then as well as ending it with why time horizon matters or overall context of your time in the market. So starting off with why there's or always there is something to worry about. Let's just look back at 5 years. There are headlines in every year, but just looking at 5 years to see why there were reasons for not being invested in the market. For 2018, for example, was the first time we had rising interest rates. With just under a decade of low interest rates, as well as low oil prices. For 2019, the main headlines were about trade wars and tariffs, and multiple headlines between China and US that made you assume that it's going to be the end of the world because the two major economies are, in a Cold War kind of situation. There's also fear of slowing global economy and not just developed but also emerging markets. 2020, not surprisingly, was the year of COVID-19. We had lockdowns, job losses, and basically a overall halt in global economy, as well as there was a year of US presidential election. For 2021, we saw multiple waves of 20 COVID vaccines coming out, and there was a big headline, a negative headline about Chinese real estate market, and the stimulus checks as well, which later on also resulted in a strong rally for that year. For 2022, of course, it has been all about raging inflation and rising interest rates. Despite there was no discount in the number of headlines over the past 5 years. Yet when you see at the chart, you can see that since the start of 2017, an investment in S&P 500 has close to doubled. And if you were to go according to these headlines, you would have missed out on considerable gains over that term. Looking at the chart here, at every past decline, so there's this quote in the market that says every past decline looks like an opportunity while every future decline looks like a risk. It is to say that there is a comforting delusion that if I were to time the market correctly, then surely I'll be better off dodging the downturns and get back into the market for recovery. The odds of nailing either timings, whether it be of dodging the downturn or getting in time for recovery, is frankly a shot in the dark. And it's quite visible here in the chart as well, that if you were to miss just a few the best trading days, your results in the long run would significantly differ compared to if you were to stay invested in the market during that time. Um, and in continuation of that point as well, so this data really solidifies what we've been talking about, is that 7 out of the 10 best days have occurred within 2 weeks of the 10 worst days over the past 20 years. And the market volatility often feels scary enough for you to be second guessing your long-term investment strategy. And it is helpful to think about a stat like this before you time and try and get out of the market. So there is also another stat where there says there could be a 70% chance that you'll miss one of the best days. And by doing so, you are at risk of losing out of significant growth opportunities. As you can see in the chart, the annualized performance of staying fully invested in S&P 500 over the past 20 years would have offered you an average return of 9.1%. But if you had missed just 10 of those best days, your returns are nearly halved. Now you may be thinking, maybe I shouldn't be. I understand that there is an importance of staying invested long term, but if I can tell that the market is at an all-time high, maybe I shouldn't be investing. Well, the data shows here that regardless of where the equity market stands, whether you're at a near-term high or an all-time low, longer-term outcomes really aren't all that different. Historically, we've seen that if you have invested at an all-time high, taking S&P 500, for example, your 3-month return would be 3 months return 3 months later would be 5.8%, and 1 year later would be 10.8%. And if you were to invest at an all-time low around that date range, your average return is still fairly close at 5.3% for 3 months and 11.3% for a year later. So regardless, anyhow you cut it, it shows that it does pay to hang on, even if the overall market sentiment changes. And then lastly, why time horizon matters. And you must have heard this before as well. The longer you stay invested or the time in the market, the more confident you can feel about the probability of generating a positive return. Markets can always have a bad day, a week, a month, or even a year, but history suggests that you're less likely to suffer losses over longer periods, especially if you invest in a diversified portfolio. And we can see that here with a 50-50 portfolio. So now that we've talked about why you should stay invested, oftentimes it's not a question of why, it becomes a question of overcoming your market anxiety, overcoming your fear of losing out on a lot more. So there are some strategies you can take into account when you deal with a rough market, as we are in currently. Is that one of the first things you do is avoid the temptation to look at your portfolio every day. A movement of more than 5% now per day has become a lot more common than it was before. And every time you look at your portfolio numbers, it makes you question if the fundamentals of your investments are right, if the construction of your portfolio is right, which might not be the case, because sometimes there are some days where market is just overreacting to a news, and it does stabilize later on in the long run. The second point you can do is reduce your risk through proper diversification, whether it be through asset classes, sectors, or geography. Again, as mentioned in the previous slide, the 50-50 equity bond portfolio has worked for many investors, and that allows you to be exposed to different correlations, different growth prospects, as well as bringing in some stability and maybe sometimes some income, depending on what your overall goals are. The third point is that be greedy when everyone else is fearful. When the market sentiment is down, stocks are relatively more cheaper when it comes to valuations, even if they're, at the same revenue base or the same earnings per share base as they were 2 years back. So oftentimes times like this bring you a lot more opportunities than worries about losing further by investing in them. It is also helpful to look back on your long-term financial goals and planning. And if you have thought through for example, if you're looking at a stock and you originally planned to invest in it for 5 to 10 years, it is important to go back and revisit those fundamentals and see if they still hold strong. Of course, staying invested does not make sense if there's a shift in the fundamentals overall within that company or within that ETF that you're looking at, but it is important to go back and see why you had liked this one in the first place. Another point to consider is tax loss harvesting, which allows you to negate your losses against some of your gains if that is a possibility. And the last point is to remember that investing beats cash, which is particularly true this year where inflation has been raging, and even holding cash, you're basically losing out just by holding cash. All right, so the bottom line here is that diversification, time in the market, and a steady head can help investors achieve their long-term financial goals. It is important to avoid the pitfalls of being emotionally driven, badly timed market mistakes. And when times get tough in the market and make you feel nervous, it is important to think of the sale opportunities that are available in the market currently, as well as remember the lessons of tried and true investing principles, which basically talks about staying invested over the long term.